thank you to all of our presenters. Now let's get into the Q&A. In order to maintain social distancing, I'm joined here in the studio by Mike, Ganesh, Olivier, George, Katie, and VIJAY. And joining us remotely, we have Jeff, Nate, Tomas, and VISAL. All right, let's get started. We've gotten a number of questions that came in throughout the program, and we've aggregated a lot of those questions, and we're going to try to get through as many of them as we can. So we're going to kick things off with Olivier. How should we think about revenue, margin, and EPS growth phasing from FY22 to FY24? And what are the drivers of the North America weighting to margin expansion versus some of the other regions?
So if you look at the revenue, we believe that the revenue over the 3 years is going to be more or less equally distributed. If you go down to profit, because of the impact of our productivity program, which is going to be stronger in 22 and in 23, we would expect profit and EPS over those 2 years to be stronger versus year 3. To answer to your second question, if you look at our North America business, because of the impact of our productivity program in this business, centralizing, standardizing, eliminating duplicate work, and because of the vector of growth, which will have a high impact in this business, we believe that the margin in North America would increase more than in the rest of the portfolio.
Thanks, Olivier. So staying with Olivier, 2024 guidance seems to imply 20% base operating leverage when you exclude all the savings from our cost of sales program and SG&A program over the 3 years. Could there be upside to this, particularly if there's services outgrowth?
It's possible. We took today a balanced approach to do our financial plan to you. It's possible that the vector of growth we are today trying to plan, which are going to be rich in recurring revenue, rich in margin, could deliver upside on the top line and also on the bottom line. That's possible, but we believe that a prudent approach is the one we have been communicating to you.
Thanks, Olivier. So turning it over to George, what does the 6 to 7% sales CAGR target embed for fire and security versus HVAC growth?
Yeah, I think the way that you have to think about it is the vectors of growth is really going to lift all of our businesses equally. And I think when you think of fire and security, historically, it's been lower growth than HVAC. But with the connectivity and the importance of the censoring and the detection, and then ultimately to analyze and then ultimately create outputs, it is a critical element of smart buildings. You know, a good example is when we talk about healthy buildings, the ability to be able to use all of our security censoring to understand occupancy, and that combines with our control systems in OpenBlue to make sure that not only we're elevating the health and safety of the building, the air quality, but at the same time that we're driving energy savings and driving sustainability. So as you think about all of the vectors of growth, it becomes a very important element of that, and I think is going to be fundamental to our ability to be able to differentiate the solutions that we bring to all of the key verticals that we support.
Thanks, George. And just to build upon that, Tomas, do you want to share some of your discussions with customers and how fire and security comes into those conversations?
Yes, for sure. Thank you, Antonella. As George already mentioned, the fire and security platform together, of course, with HVAC and controls, are already critical enablers for smart buildings. And both of these subsystems keep occupants safe and healthy in the building environments, as well as enabling experiences and added services based on our OpenBlue application. So these fire and security systems with a vast network of connected edge devices are the key to these outcomes. So just to give you an example of what we are installing is, for example, as part of our OpenBlue Healthy Buildings program, we leverage our frictionless access control technology to create a seamless experience for individuals that comes in and out of spaces. And this then coupled with our OpenBlue companion occupancy measures ensure that social distancing protocols are met and enables the right airflow to keep the space safe and healthy.
Thanks, Tomas. And we're going to go back to Olivier. Olivier, what are some of the assumptions around the 80 basis point sales CAGR contribution from our vectors of growth? And is there scope for this to be stronger?
Again, we took a balanced view regarding the planning of those vectors of growth, and we see those vectors of growth, it's kind of obvious, to accelerate over the 3 years period. It's possible, as you saw from today, we believe we have deployed agents and controls, a formidable way to serve those vectors of growth, and it's possible that we got it maybe slightly wrong and maybe slightly prudent. But we think that today, with the information we know, that's the best way to plan for the enterprise.
Thanks, Olivier. We're going to go back to George. So does the mix of equipment versus controls or software change going forward? And does this have implications for the labor required or on the margin mix?
Yeah, so as you think about controls and software with OpenBlue and the vectors of growth and being able to deliver on the outcomes that we're delivering, as Vijay showed, we're going to see double-digit growth within that segment. And that's where we have higher margin. It also enables recurring services, which are higher margin. And so certainly with that mix, with the higher margins, that's going to contribute nicely to our margin rate and overall the contribution to the growth that we're going to achieve.
Great. So George, while we have you, it seems like we'll be able to deploy $7 to $8 billion in free cash flow after dividends in the next 3 years and stay within our target leverage range. What are your thoughts on sizable M&A?
Yeah, so the way that we think about it is when you look at the vectors of growth and the opportunity that we have to be able to take advantage of that and differentiate what Johnson Controls does, we're very much focused on our organic execution. And then with that, as we look at M&A, how do we make sure that we look at not only organically what we're developing, but other key capabilities, whether it be digital, supporting our services, continuing to strengthen our product, that truly enables us to be able to now capitalize on these trends. So I think about it as bolt-on acquisitions, enabling us to be able to accelerate the execution of these vectors of growth on a go-forward basis. And that should add, on an annual basis, about 1% to 2% top-line growth above and beyond what we achieve organically.
Thanks, George. And Olivier, back over to you. You reiterated our Q4 and fiscal 21 guidance this morning. Several companies have cut their near-term growth on supply chain, chip constraints, labor, and commodity inflation. Can you talk a little bit about how we are offsetting these?
So if you look, so we're confirming all the elements of our guide, as you said, Antonella, on revenue, margin rates expansion, EPS, and cash flow. And if you look at the quarter at the moment, we are very pleased with the order velocity. And as a result of this, our backlog is actually record high. So that's for orders. If you look at margin expansion, we are very pleased with the margin expansion we have had, and as a result, very pleased with the EPS we are able to pull through. Same also on cash flow generation. Today, because of the raw material shortages, as you said, Antonella, affecting all the industries, we have today our revenue being under pressure. While being in the guide, our revenue organic will be under pressure. Our teams are doing a great job. All the vector of growth we went through this morning actually playing out as expected or better. And we have to manage this short-term situation.
Thanks, Olivier. And now let's hear from a few of our other presenters. So Vijay, how is OpenBlue differentiated versus a controls company or other HVAC OEMs and potentially even startups? How does having HVAC equipment and fire and security field make OpenBlue differentiated?
Thanks for the question, Antonella. OpenBlue is differentiated because of the holistic nature of the solution, as we shared in the presentation earlier. So OpenBlue builds upon control systems like Metasys, integrates other building management systems like security, HVAC, as well as the chillers. So it really is much more of an integration, and it brings together that data in a single repository, applies the AI and ML, and produces those scalable experiences that we talked about. It does that at the building level, the campus level, the global level, and it does it with both Johnson Controls and non-Johnson Controls product. The other elements that makes OpenBlue differentiating is its ability to actually connect with business systems such as service dispatch systems, such as wireless systems that are on site, scheduling systems to automatically book conference rooms. So we've built those integrations into OpenBlue that can not only connect and gather that data about those business systems, but also to leverage scheduling systems and dispatch systems that automate the workflow on how work gets done within the campus ecosystem. And then finally, we have deep integrations into vertical systems as well in areas like hospitals as well as airports, where we are actually integrated into those systems to automatically be able to do things like smart patient rooms. So in a recent example, we were actually able to deploy a smart patient room at a hospital in a matter of weeks with our OpenBlue Bridge technology that actually acted like an orchestrator, bringing together all of these different capabilities: vertical systems, business systems, and traditional building management solutions. So it's that holistic nature of OpenBlue that differentiates the solution from anything else that's out in the marketplace.
Thanks, Vijay. And staying on OpenBlue, how do you scale OpenBlue for different buildings? We've heard that some controls projects are just too big to start. Is there a minimum investment level to start?
That's a great question, Antonella. And with OpenBlue and OpenBlue Bridge specifically, we provide a very scalable connectivity experience at the edge. As you remember, we talked about OpenBlue Bridge, which is essentially our iOS for smart buildings. And you can deploy OpenBlue Bridge at a single site. You can deploy it campus-wide, you can deploy it from light commercial, you can deploy it in complex enterprise. And what makes OpenBlue Bridge so powerful is that it is actually embedded in a number of different device types and gateways that have a different level of affordable investment points. And the ease of setup is a matter of a couple of hours where you go in, install the OpenBlue Bridge gateway, you discover the points that exist within your building location. You can actually visually map them using an easy to understand intuitive workflow that doesn't require a lot of sophistication. You can map what data objects get collected through OpenBlue Bridge in that same workflow. And that data within a couple of hours is flowing up to the cloud and can be delivered through OpenBlue Enterprise Manager and other experiences to provide energy insights almost immediately. So it's that scalable connectivity from light commercial all the way to complex enterprise, the ability to set up quickly, and the ability to capture data holistically in the cloud and deliver through scalable experiences that makes OpenBlue Bridge so special.
Thanks for all the color, Vijay. So let's move things over to Ganesh. Can you update us on your indoor air quality conversations, and how lasting of a trend do you expect this to be?
Thank you, Antonella. We see the indoor air quality or indoor environmental quality market to evolve to a 10 to 15 billion market by the end of the decade. And that shift is going to continue even after the pandemic effects are over. And it's really driven by three forces. The first force is studies continue to show the impact of cleaner air and cleaner environment on occupant health and occupant productivity. It's reflected by reduced sick days, improvement in student test scores, and so on. So you'll see that buildings which have cleaner air and environmental infrastructure will be able to command higher rental premiums, lower insurance costs, and all that. So that's the first dynamic. The second dynamic that's going on is the increased ability for in situ detection of pathogens in the air environment. And those technologies, as they're evolving, will also augment the application of these solutions within the infrastructure. So the second dynamic. The third dynamic is really the ability of digital technologies to balance the apparently competing demands of cleaner air and cleaner environment, along with reduced energy usage to meet sustainability goals. So when you combine all these three forces into account, you'll see that there's going to be a steady shift in terms of this market, and we see that continue to evolve over the coming decade.
Thanks, Ganesh. Now we're going to pass things over to Jeff and talk a little bit about the North America residential market. So Jeff, can you talk a little bit about what is your view on the North America resi HVAC cycle? And do you think the average life of units has changed?
Yeah, thanks, Antonella. I think if I look at the rolling 12 of the North America resi market, we're up 17% year over year. And really that's driven by, consumer demand to upgrade their systems, right, both for energy efficiency and, air quality using our MERV filters and other, UV solutions. But, in that cycle of 17% year over year growth, we are gaining share as well, right, with our business. And what I would, looking ahead, to next year and really the next couple of years, we see the market growth normalizing to mid-single digits. And so what we're also seeing is that, there's really no change in the replacement cycle. It's really between 10 and 12 years, really depending on the region in North America at this point.
Thanks, Jeff. So back to Olivier. Can you please clarify if the 1 to 2 percentage points from M&A contribution is in the 3-year revenue target or the EPS targets we provided?
It is not. It would be additional, Antonella.
Thanks, Olivier. So since that one was quick, we're going to go right to another one. So if you include all of your controls and digital revenue as well as performance contracting and add that to the $6.5 billion in services, around what total would that be of our overall revenue?
If you add all those pieces and you have some overlap between all of those, you'll be close to $9 billion, give or take, with obviously richer margin and the growth profile, which is different than the company average, meaning higher.
Thanks, Olivier. So next we're going to go to both George and Mike. You may want to chime in on this one as well. So how should we think about standalone software revenues and how this is expected to grow over the medium term? And what percentage of software is software as a service or subscription type revenues?
Yeah, so as we showed you today, that market today is about $25 billion. And over the next 10 years, we see roughly 10, 12% growth on that. And what's important is not just the standalone software, but how that comes together with all of our other digital platforms within the building and then contributes to the outcomes that we're looking to achieve, whether it be decarbonization, healthy buildings, and then ultimately smart buildings. And so you can't look at the software alone, but even that being said, it will be growing double digit, including our other digital platforms that will enable our ability to be able to capitalize on a significant opportunity in smart buildings. Mike?
Sure, thanks, George. As George just said, we're absolutely seeing significant growth. And when you think about digital and the digital revenue amount itself, we're tracking at around $4.2 billion this year. We're seeing that growth and projecting in 24 to be at around $5.6 billion. And of course, software is a key element of that. As George mentioned, we're experiencing software growth in the double digits.
Thanks, Mike. Thanks, George. So Ganesh, as attach rates increase, who is losing share? Would you say that it's some of the smaller companies? Is it some of our larger competitors? Or is it more to in-house maintenance? And what measures are we taking as well to lower attrition rates?
Absolutely, Antonella. Thank you for the question. It's really all three segments, service providers, competitors, as well as customers who have in-house capabilities. And if you think about the main trend which is driving that is the shift from a fix, repair, maintain type of a service model towards an outcome-oriented service model. And that is actually being, the impact of these outcomes as service solutions is really what is driving the improvement in attach rates. Now, with respect to the question that you asked about attrition, we have developed fairly robust models, analytical models based upon artificial intelligence and machine learning, which have the ability to predict potential attrition within our customer base to a fairly high level of precision. And these attrition model analytics are primarily applicable in areas where we have large volumes of customers with relatively small dollar base, for example. So to use these models against that customer base actually allows us a significantly amplified capability to dovetail who is likely to attrit and also take targeted surgical actions against those customers to mitigate the likely effect of attrition.
Thanks, Ganesh. Olivier, in the plan, assuming that we add 1 to 2 points from acquisitions, what would you say our ending fiscal 24 leverage would be expected to be? So
if you look at our leverage level today, which is around 1.8 1.8, if you look at the profit growth, we will be comfortably within our leverage guide by deploying cash to do 1 or 2% of additional growth, comfortably within the range.
Thank you, Olivier. So George, could you comment on service margins, particularly in fire and security? It seems that these are high single digits and some of our peers recently sold businesses. Is that representative of our portfolio?
Not at all. When you look at our fire and security business today, it's about $4 billion in revenue. And when you look at our service that we get from that install base, it's significant and it is very high margin. So we have a very different portfolio than the competitor that I think you're referring to. And then more important, as we think about the solutions that we talked about today, it plays a critical role with the sensoring and the detection, and then the ability to be able to analyze the data and contribute to the outcomes that we're ultimately putting together. That's going to be the acceleration of our growth going forward. And so I wouldn't think of it as compared to our competitor. I would think of it as a key part of the portfolio that ultimately is going to enable our ability to be able to deliver on these significant opportunities.
So staying with George, what is your strategy policy on pricing your products and services for the additional benefits we bring to customers? And do you price to provide a certain return?
Absolutely, Antonella. I mean, we've implemented strategic pricing across all of our businesses. And as we've gone through our transformation within the company and now being able to deploy the capabilities that we have in new business models, it's all about the value creation that we deliver for our customers. And so around whether you talk about decarbonization or healthy buildings or smart buildings or digital services, it's all about what is the value now we can create, and then how do we create a return for our customers, but at the same time get the appropriate return for the investments that we're making, especially into the software capabilities as we're deploying OpenBlue. And so we're very disciplined. We've been in an inflationary environment. We've been very disciplined about what that impact is not only this year, but as we go forward, and we've executed on that extremely well.
Thanks, George. And we're going to turn it back to Ganesh. So what do you project will be the % of recurring revenue in fiscal 24?
Antonella, currently the base of our recurring revenue is about 55% of our total portfolio, service portfolio. We expect that to continue as we head into 24 because we see a very nice lift in terms of recurring revenues, but at the same time, the pull-through from our non-recurring labor and material part of the portfolio is also going to pick up significantly. So from a mix perspective, it's still going to be around 55% of the total portfolio.
Thanks, Ganesh. So the next question I think could be a tag team here between Mike and VIJAY. Could you talk a little bit about our go-to-market strategy related to OpenBlue, and how does that differentiate between a new customer and one of our existing customers?
So maybe I'll start real quickly. Think firstly our core. So it's about services. How do we digitize our service platforms and capabilities so we can enrich that whole service experience? Of course, that drives reoccurring revenue and attached to those customers, and really creating a digital layer that's insightful and provides new levels of understanding what's going on with all the equipment, systems, core platforms, OT and IT, as we talked about in our presentation, and bringing that all together into a really unique opportunity for us. Of course, that does translate also into solutions that we talked to earlier this morning, and that is around outcomes. So around sustainability, around healthy buildings, around extraordinary customer experiences within those buildings. VIJAY?
Yeah, I think to add to what Mike just said, the partnership between the OpenBlue engineering organization and our field organization is extremely strong. So we're constantly working with the field to understand what those customer pain points are and building solutions that are applicable to a set of verticals and a set of outcomes that are coming in from the field based upon all of their experiences. In addition, we have digital solutions teams, Tiger teams that work very closely with the engineering organization as well as the different customers to understand how OpenBlue will really fit into their set of solutions to drive the desired outcome. So I think between the capabilities, the partnership between engineering and the field organization, and our outcome-based focus working with the field, we have a really strong proposition on how we go to market.
Great. Thanks, Mike. Thanks, Vijay. So the next question is around heat pumps, and we're going to ask, Tomas, if maybe you can start, and then we could go to Visal. So many of our peers are talking about heat pumps. Can you give us a little bit more color on the differentiation in the JCI portfolio?
Yes, Antonella, I think it's fair to say that in the complex market, our heat pump are very efficient. They are very good with the GDP factor, and they also operate at a very high temperature. So this means that we will be able to offer really good economics and really good lifetime cost for our customers. And we also have a long, I would say, experience in how we define the project, how we size the project, and how we execute the projects. And those have clearly been some really good success factors in the execution during the last, I would say, 12 to 24 months.
Visal, anything you'd like to add?
Yeah, so where we have seen success for heat pumps in Asia Pacific is really in China, in district cooling, in district heating. I think the key differentiator here in China is, of course, the legislation, which is pushing towards decarbonization. We talk about that. But also for JCI, for Johnson Control, we have a leading position in the HVAC market, about 20% market share. We have a brand name which is very well recognized. We have done a lot of work with the government to position ourselves. And we also talk about our direct relationship with customers and our channel to market, which is really second to none. So this really put us in a great position in terms of reference and going forward in terms of market opportunity.
Excellent. Thanks, Visal. So next we have a question on supply chains in general. So Olivier, I'm going to ask this one for you. So supply chains have continued to tighten. So have we had to accelerate our productivity programs to offset in this particular environment in order to meet our short-term financial targets?
We haven't accelerated the program for that reason. Today, the programs, and I've said that when I presented earlier, are really well on track. The commitment, which are net commitment, I repeat the number, 550 million net by 2023. We're well on track. We have transformation teams across the enterprise. Our incentive program also embed this productivity program to ensure focus. So we are well on track. We're pleased with the advance of those productivity programs, but we're not accelerating them in any way because of supply chain.
Thanks, Olivier. So the next question is for Katie. Can you talk a little bit about the infrastructure bill and how that could potentially impact Johnson Controls?
Yeah, thanks. So if I could paint a little bit of a bigger picture first, I think a theme that you have heard throughout the day is we're a different company and the world is different too. And that's the backdrop for these bills. In terms of a different company, we're delivering those solutions, pure play, sustainable building technologies, and we're becoming known now increasingly for that. Now, coincidentally or not, the world is changing in sync with that, right? So the focus is about climate change and it's about healthy buildings. Put those two things together, and what we're seeing, as I kind of alluded to, I've been at this 30 years. Buildings were always in the back seat in terms of environmental policy. Not anymore. That's the story, whether it's building performance standards, the infrastructure bill, the energy bill, what Visal just described in Beijing. Buildings are front and center because leaders are understanding that piece of 40% of emissions coming from buildings. And so what we see then, Antonella, is some very key provisions talking about investing in smart buildings. Further understanding, let's leverage those dollars through performance contracting. So I think the message is heard, and we're seeing the fingerprints of it in legislation around the world.
Thanks, Katie. So our next question is going to go to Ganesh, and then maybe Nate, you can add a little bit of color given the size of our service business in North America. So Ganesh, if you start us off, can you expand on how you see the company's service organization becoming leaner and that transition to outcome-based and digital services?
Absolutely. That's a great question, Antonella. I think when I took all of you through the digital service transformation framework earlier, it's about, first of all, it's about creating value-added service offerings that are highly monetizable in the market in terms of increasing the value content. Simultaneously, what we are also doing is ramping up our capabilities to market, sell, deliver, and support these services by improving the digital competencies and the digital capabilities of our technician field at the field level. And in terms of improving our systems and our workflows and our processes to enable subscription-based access, which are in line with the digital solutions that we are offering. So these are some of the important capabilities that we are building to enable the penetration of digital services in the field. And I'll let Nate share his perspectives on that.
And I would say, in addition to that, Ganesh, in our performance infrastructure business, we use our digital service offerings to also underwrite our contracts when we sign contracts that are 20, 30 years long, when we have guaranteed outcomes with our customers. So I would add that into addition to what Ganesh has said.
Thanks, Nate. So one more question, George, before we wrap things up. So what would you say is the single differentiator for JCI to drive share gains when it comes to decarb, digital, and smart buildings?
Yeah, the clear differentiator is OpenBlue. When you combine OpenBlue with the install base that we serve and the direct channel that we ultimately serve our customers, it becomes a huge differentiator and totally disrupts the industry with our ability to be able to deliver autonomous buildings longer term. And we're deploying that pretty much across all of what we're doing, not only in our installation business, but our service business, and is going to be fundamentally leading the industry with the differentiated capabilities.
That's all the time we have today for questions. So George, any final comments?
Yeah, first I'd like to thank everyone for joining us today. I think you've seen today that JCI is a different company. A few key thoughts as we wrap up. Johnson Controls, we're positioned in a very attractive market, and we're very excited about the growth vectors that we see going forward. I think we've made the case that OpenBlue is going to be the differentiator. It is going to fundamentally change how we go to market with new business models, creating outcomes, and now being able to capitalize on that exciting growth. I think you've also seen we've got a very strong leadership team that is absolutely committed to being able to deliver top-tier financial performance with very, very attractive shareholder returns. And so as you think about the choices that you make with your investment capital, I'd also like to leave you with the fundamentals that we're positioned to be able to achieve over the next 3 years. Johnson Controls is positioned to be able to outperform the market with above-market organic growth. And then when you look at our margins, we're going to continue to be able to drive strong productivity, cost out, and be able to leverage the volume to be able to deliver very, very strong margins over the next 3 years. All of that will deliver very strong free cash flow that gives us tremendous capacity to be able to reinvest and ultimately add to our growth through M&A. And then all of that together positions us to be able to deliver very strong double-digit adjusted EPS growth over the next 3 years. So again, I want to thank you all for joining us, and we look forward to following up and having multiple follow-up discussions with each of you after today. Thanks again.
Thanks, George, and thank you to all of our presenters. We appreciate you taking the time today, to all of our shareholders and analysts, for joining us on your busy schedule to learn about our exciting future. And as always, Ryan and I will be available to answer any follow-up questions. A replay of the event will be made available on the Investor Relations section of our website. Thank you again.
Thank you for watching Johnson Controls Investor Day.